The Shanghai silver market has become the foundation of global price discovery. Physical trading in the East now influences prices before paper markets respond. This shift is quietly changing how silver is valued worldwide. Silver is no longer just a metal. It has become a strategic signal. Price charts show movement, but structure reveals the real story. Inventory levels matter more than opinions in supply-driven markets. When supply tightens, behavior changes faster than expectations. Crowded physical exchanges reveal stress long before headlines appear. Traditional investment strategies assume slow and orderly price action. Vertical markets do not follow those assumptions. Dollar-cost averaging works best in stable environments. In accelerating markets, it often becomes a disadvantage. Investors end up chasing prices instead of securing position. This pattern repeats in every supply-driven cycle. Structure determines outcomes more than sentiment. Physical demand reshapes how corrections behave. In scarcity environments, pullbacks lose depth. Any decline is quickly absorbed by prepared buyers. Automated systems dominate modern price efficiency. These systems react in milliseconds, not minutes. Human hesitation creates opportunity for algorithms. Cheap metal disappears faster than manual decisions can be made. This compresses the window for entry. Waiting for perfect confirmation often results in missed opportunity. Front-loading capital becomes protection, not speculation. Securing physical silver early reduces long-term exposure. Ownership matters more than perfect timing. Physical silver behaves differently from paper promises. Paper markets fluctuate without affecting real-world availability. Physical markets respond only to supply and demand. Selling tangible assets for weakening currencies increases risk. Fiat systems expand faster than productive output. Purchasing power erodes quietly over time. Hard assets resist dilution because they cannot be printed. This is why capital rotates during periods of monetary stress. Shanghai demand increasingly overrides Western price signals. Wealthy investors rarely convert hard assets back into fiat. Instead, they exchange undervalued assets for other undervalued assets. This approach minimizes exposure to currency depreciation. Silver remains historically mispriced within this framework. Volatility is part of repricing, not a warning sign. Emotional reactions increase as prices move vertically. Media noise intensifies during structural transitions. Discipline becomes more valuable than prediction. Physical demand now dictates global market behavior. Strategy replaces short-term speculation. Arbitrage tightens price gaps between regions instantly. Eastern buying forces Western markets to react. Industrial demand adds constant pressure to supply. Opportunity appears before consensus forms. Early positioning always feels uncomfortable at first. The silver market is changing, and positioning decides. Once structure is understood, strategy becomes the decisive factor. Many investors study charts without questioning what drives them. Markets move on forces, not opinions. Strategy must adapt when structure changes. Silver is now influenced by physical demand more than speculation. Early positioning matters more than perfect entry. Front-loading capital is not aggression. It is defense. Physical ownership reduces exposure to sudden repricing. Ratio analysis provides context that price alone cannot show. Gold and silver move in cycles, not isolation. Automated arbitrage systems enforce price efficiency globally. These systems react instantly to imbalances. Human hesitation creates opportunity for machines. Cheap silver disappears before most investors respond. This is why waiting for confirmation often fails. Physical transport reveals real demand. Crates moving matter more than contracts trading. Paper exposure does not guarantee availability. Physical silver behaves under different rules. Demand floors form where scarcity meets necessity. Shanghai demand has established a powerful price base. Pullbacks lose depth in scarcity-driven markets. Large buyers treat dips as inventory opportunities. Risk calculations now prioritize ownership. Currency weakness adds pressure to tangible assets. Fiat systems expand faster than productive output. This expansion quietly erodes purchasing power. Hard assets resist dilution by design. Wealth preservation depends on recognizing this imbalance. High-level investors exchange value, not currency. Industrial demand operates independently of sentiment. Factories accumulate based on need, not price emotion. Volatility reflects adjustment, not instability. Strategic accumulation ignores short-term noise. Discipline separates positioning from speculation. Eastern markets increasingly lead price discovery. Western markets respond rather than initiate. Price convergence between regions becomes inevitable. Ratio-based strategies guide long-term allocation. Checkpoints help preserve purchasing power. Emotional reactions increase during vertical moves. Media narratives amplify uncertainty. Structure remains unchanged beneath the noise. Physical delivery becomes a priority. Paper profits fade faster than real assets. Arbitrage and industrial demand drive repricing forward. Global trends now favor tangible ownership. Market fundamentals outweigh short-term volatility. Shanghai spreads reveal pressure before charts do. Repricing accelerates once scarcity is recognized. Strategy succeeds when aligned with structure. The silver market is evolving, and preparation defines outcomes. Supply constraints change markets before prices react. Silver availability is tighter than charts suggest. Industrial demand does not wait for confirmation. Factories secure metal before shortages appear. Warehouses reflect reality better than screens. Physical inventory reveals stress in the system. Arbitrage algorithms scan global prices relentlessly. They remove inefficiencies faster than humans can react. This creates sudden upward pressure. Physical demand reinforces that pressure. Capital front-loading is a response to scarcity. Early action protects against future repricing. Currency weakness amplifies hard asset demand. Silver responds directly to monetary dilution. Ratio analysis offers strategic clarity. Gold and silver ratios guide allocation timing. Late investors often recognize shifts too late. Opportunity windows close silently. Shanghai demand floors stabilize volatility. Price dips lose effectiveness in tight markets. Manual trading struggles against automation. Strategic positioning matters in vertical markets. Physical ounces provide control. Paper exposure introduces uncertainty. Volatility separates structure from speculation. Industrial demand accelerates repricing cycles. Disciplined investors ignore emotional narratives. Accumulation follows ratios, not headlines. Checkpoints protect purchasing power. East and West markets influence each other asymmetrically. Holding metal differs from chasing price. Delivery takes priority when trust erodes. Arbitrage synchronizes global valuation. Long-term volatility rewards patience. Shanghai gaps reveal pressure points early. Scarcity reshapes behavior across markets. Fundamentals dominate short-term noise. Vertical moves test discipline. Physical assets retain value during monetary stress. Ounces secure purchasing power over time. Spread monitoring informs timing decisions. Repricing phases unfold gradually, then suddenly. Industrial hoarding reduces visible supply. Eastern buying influences Western pricing. Strategy replaces speculation during transitions. Ratio checkpoints guide asset rotation. Industrial signals precede financial reactions. Capital flows toward tangible security. Timing physical acquisition requires patience. Demand floors redefine downside risk. Automated systems capture undervalued metal instantly. Market structure now dictates silver strategy. Supply constraints are changing global silver markets before prices react. Investors must recognize that availability is tighter than charts suggest. Industrial demand moves ahead of any market confirmation. Factories are securing silver before shortages appear. Front-loading capital ensures early positioning in a vertical market. Waiting for pullbacks may result in missed opportunity. Shanghai's physical demand creates a strong price floor. Automated arbitrage reacts faster than any human investor. Selling silver for dollars may not make strategic sense. Paper currencies are being debased. Physical assets retain real value. The wealthy rotate undervalued assets instead of relying on fiat. Gold to silver ratio provides a roadmap for positioning. Accumulating silver when ratio is high captures long-term gains. Trading some silver for gold when ratio drops protects purchasing power. Ignore short-term volatility, focus on Shanghai spread. Industrial demand is driving repricing across the market. $70 is a launch pad, not a ceiling for silver. Patience and strategy are key in supply-driven markets. East is buying, West is reacting, creating a clear directional force. Hold physical silver and secure delivery. Avoid chasing paper profits. Follow fundamentals, ignore speculation and media hysteria. Vertical markets behave differently. Corrections lose depth. Strategic accumulation secures ounces ahead of rising prices. Front-loading capital reduces long-term exposure risk. Physical markets respond only to supply, logistics, and demand. Selling tangible assets in fiat introduces long-term risk. Fiat expansion erodes purchasing power steadily. Physical assets resist digital dilution and preserve wealth. High-level investors exchange undervalued assets strategically. Silver remains historically undervalued in a scarcity-driven environment. Volatility is expected during repricing, but long-term supply constraints matter. Strategic positioning focuses on ownership, not price swings. Emotional reactions intensify during vertical price moves. Discipline outweighs prediction in transitioning markets. Physical demand now dictates global market behavior. Effective strategy must adapt to this new reality. Timing capital deployment is critical for vertical gains. Industrial hoarding is reshaping supply dynamics. Automated arbitrage captures cheap metal instantly. Investors must act strategically with resources, ignoring short-term noise. Long-term accumulation ensures wealth preservation. Ratio-based positioning provides clear trading checkpoints. Monitoring Shanghai spread identifies strategic entry points. Securing physical silver early protects purchasing power. Market structure is shifting forever, requiring strategic long-term action.